Good morning and welcome back to Almus Market Mornings. We start another week, and for a change, this week promises to be different from others as finally we will start getting some data from the US economy. Though keep in mind, it may be that some of it may be old data, but Thursday's employment report might be something that interests investors, though it's for the month of September. Till last week, many Fed members have pushed back against the December rate cut, and that has recalibrated markets' expectations as well. Domestically, the RBI has announced a host of measures aimed at providing relief for the trade-affected sectors, including a moratorium and enhancement of the export credit period. Good morning, JK. How do you think markets will now take the data being released? Do you think it can be a market mover?
Good morning, Swaraj. Yeah, at last we are getting some indications on the economy. So there's a kind of fog over the entire ecosystem of how the economy is working, particularly on the jobs market and also the inflation numbers. So this comes as a relief. But then, as per the statement, they are going to release September jobs report on this Thursday, and as per earlier report, October numbers will not be released. Now, what is key is that the US shutdown started on October 1st and ended in first week of November, and market would be very keen. Rather, it ended on November second week. So, market would be keen to see what happened in October, the impact of that, rather than what happened in September. So, I think this is not going to be very significant from the market perspective. They also said that they may not be announcing the unemployment rate, if I'm correct. So some reports said that it will be only the numbers. So it's not going to give any major guidance. Of course, there are also indications that the international trade figures will be announced on November 19th. That is also again for August. Commerce Department will be releasing the Q3 GDP third estimate only on December 19th. So that would have been normally announced end of November. Then the personal income and spending, the PCE inflation, which is very key for the Fed decision, also will be announced only on December 19th. So again, that would have been announced end of this month. So there is still a lot of gap for the data for the market to analyze, as well as for the Fed to deliberate on the monetary policy. There's a lot of gap. I think we still will have a lot of uncertainty even after the data is released. Is not going to be complete. I think it will be only the month of January by when we should be getting almost all the data and complete picture of what happened from in the last fourth quarter of the year as well. So that's my view. Of course, there are also, the Fed members' views that is continuing to stress upon caution about interest rates being cut once again. Very clear statements from some of them that policy is not very restrictive. Therefore, the uh, Fed has to move in a cautious manner. In fact, the decision by Trump to reduce tariffs on some of the key goods of consumption being imported from other countries, which was in fact as a response to the recent elections that were held and that went in favor of the Democrats, also indicate how the inflation is actually affecting on the ground level. While we are seeing the inflation rate around 3% to 3.1% consistently, what the reality on the ground is hurting the consumers and indirectly the politicians as well. So I think that is the key. And so this will be something that the market will be watching, because this can also give relief to some of the countries like India and others who are exporting to US. Apart from that, of course, the market is also watching out for how the Supreme Court decides on the Trump tariff. The second level of hearing will also start in the third week of November. Mostly the results are expected in December. or rather the decision by the court is expected in December. That can be a source of volatility also for the market if they decide to strike down the legality of the tariffs, and that can lead to a lot of volatility in the market as well. We no I'm also seeing some sort of build up of stress in the bond market, because as we have seen, the US fiscal deficit, while it continues to soar, the treasury borrowings have been quite high, and the responses to the recent issuances have been quite lukewarm. Besides large debt being raised by mega tech companies for their investments also. So these can eventually lead to further rise in yields in the market, in which most investors are overly invested actually. In fact, on Friday, we have seen a big jump in both the 10-year and the 30-year US yields. Now, adding to these situation in US, we also had in a situation in UK where the 10-year yields have soared by 15 basis points on a single day on Friday after the government shelved plans for raising income tax rates. From the low of 4.37% on October 22nd, the 10-year yield now is higher by about 21 basis points. So further rise would bring back fears of another bond market turmoil like the one we have seen in September 2022. Over the last 24 hours, even government in Germany has agreed on several measures of subsidies to support the industries. There also the government is very concerned about the sluggishness of the German economy. Some liken the current weakness of the Germany to lowest in the last 80 years. So while it is not showing up so much in the numbers, again, I think the lack of investments and the growth in key sectors is being seen by the government as critical. So the fiscal spending is increasing in Germany as well. Japan is already contemplating a much larger fiscal spending this year to support the economy. So if you look at the overall picture, the fiscal is getting looser and looser, and that actually can lead to bond market coming under stress, bonds being sold and the yields getting higher. Already seen Japanese 10-year yields today starting at its highest level. So that's one market that we need to watch out for. And we already have had last week volatility on the stock market in tech sector, which is again leading to some sort of a collateral damage on other markets as well. While the overall markets did recover later, but they do not look as bullish as they were before. I think we wait to see the reactions this week from the market players. Now, even as we head into the year end, there can be more profit taking that can see the market correct itself. Of course, we have the big numbers from NVIDIA this week. The results will be very closely watched by the market also. On the Indian side, of course, we have had, I think, for a change, we have had a positive number for the week ending 14th November. I think Indian markets, in fact, performed better. Almost 1.6% rise in the key NSE index, while most other markets were either marginally negative or slightly positive. So India, for a change, did outperform. Yes, as you mentioned, there is a lot of announcements by the government in support of the export sector, which is affected by the trade tariff at 50%, and I think the moratorium and also the longer period allowed for realization of export proceeds. See, all these things, while it will not push up the exports, it will give time for the companies to adjust themselves to the new situation, perhaps find new markets for their products, and businesses to go through this tough period without too much stress is what the intention is. So in the meantime, we are also seeing some news reports that India will be signing the trade deal by end of December, and there can be some give and take on the market import of soybean and corn from the US, which will be, of course, used only for ethanol and not for consumption purposes. So I think the election results have also given a boost to the government to go ahead with their negotiations, perhaps giving some more concessions to the US, and we should expect the deal to come through. Although there has been quite this has been talked about for quite some time, but I think considering the sensitive nature of from the Indian perspective, as well as the US, also viewing that the tariff, trying to get the maximum out of their tariff policy, is holding back the deal right now. Rupee, we did not see again much movement. It still hovers around 8870, 8875 levels, and not seeing much of that movement in there. Because we still have a lot of things happening in the market, which the market will try to digest unless we see a big shift in the flows pattern for India. It's very unlikely that we will see a turn in the rupee. At the same time, we are also seeing a consistent selling by RBI at higher levels, not allowing the rupee to weaken. So it's still a wait and watch as far as the rupee's trend is concerned. Thank you.
Thank you, JK. And as you mentioned, a lot of data will be released this week, though the utility of the data may not be appropriate because for example, the September number would be released for the job markets, but markets are more keen to know how the October data was, which actually may not be released at all, both employment and the CPI. So there's a lot of gap in data for the markets and the Fed to digest, and how they navigate that would be crucial. Fed members continue to caution against a rate cut in December. A lot of them feel the policy isn't much restrictive, and there needs to be some caution. Interestingly, President Trump has also reduced tariffs on key consumption goods, for example, like coffee, and this may also provide some relief for countries exporting these commodities. Uh, and on Friday, we saw a jump in yields across the board. US saw some jump as the Treasury borrowings got lukewarm response. UK gilts jumped after the government shared plans for hiking taxes. And on the other hand, in the domestic markets, for a change, Indian equities did better last week, holding up amidst this global equities sell-off. And recently, a lot of support by government and the RBI for exporters impacted by tariffs. We did not see much of a movement in rupee. It continues to hover around 88, 70, 75 levels. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.